Good morning, one and all. I'm Ravindra Rao from Kotak Securities, and I'm back with yet another weekly synopsis for commodities and the focus for the current week. Commodities noted mixed trade as gold and silver fell sharply while industrial metals rallied and crude oil struggled for direction. The week was once again dominated by central bank interest rate decisions. The RBA and BOC held rates unchanged, but the week's highlight was ECB. With inflation over 3%, traders expected ECB to go Fed's way. However, it seemed more dovish. The European Central Bank decided to leave its key interest rates unchanged and set a moderately lower pace for the COVID 19 pandemic related bond buying. ECB took a small step towards unwinding stimulus but did not surprise market players, maintaining a largely cautious tone. This was the major support for US dollar as the US dollar recovered after falling sharply last in the previous week on back of disappointing NFP print. The DXY index closed 0.6% higher at 92.64 last week. Uh, it also got support from number of Fed officials as they supported tapering this year despite weaker jobs report. Meanwhile, US PPI data showed rising price pressure, further strengthening case for tightening. The US dollar has also benefited from cautious tone of other central banks. On the technical front, we mentioned last week that 92.45 should act as a good resistance, but the bulls took the price past the resistance, and it is currently trading near 92.60. As I mentioned, the dovish tone of the ECB has helped dollar to recover, and it is trading above the resistance now. So now 92.40, 92.30 would become the support, and on the higher side, 93.20 is the resistance. So until 93.20 holds, the bearish tone in dollar index will be still intact. The CPI data this week and Fed's monetary policy next week would set a tone for dollar index, the future direction. And as I mentioned, till 93.20 holds, the bearish tone continues. Only a close above 93.20 might reverse the bearish tone in dollar, and it might turn it neutral. A rise in dollar index has supported the bears in gold, and COMEX gold fell for three of four trading sessions last week and ended with a 2.3% decline, marking its first fall in 5 weeks. Gold came under pressure after failing to sustain above the 1834-1836 announced mark. Now this we have been mentioning since past few weeks that gold is not able to move above 1836. Having said that, 1836 announce has become a very important resistance. Any closing break above this might again give the bulls the edge to take it close to 1880, 1900 levels. So currently weighing on gold price is the firmness in US dollar index. COMEX silver has slumped 3.6% last week, reflecting losses in gold and on back of weaker investor interest. However, firmness in industrial metals and improving outlook for Chinese economy has put a floor on falling prices. So, gold has corrected sharply after failing to sustain above 1830, 1834, 1836. However, price is still in a narrow range near 1800 ounce. Gold and US dollar have been volatile as market players try to assess Fed's monetary policy outlook. We may see continued volatility as market players react to economic numbers and central bank comments to take a cue on Fed's monetary policy ahead of the next meeting on September 21st, 22nd. Market players may look at the economic data, especially the CPI data, CPI print, to form expectation for Fed's monetary policy. Forecasts indicate that price pressure has eased last month but still remains at elevated levels. If number is in line with or higher than expectation, inflation concerns may increase, further making a case for Fed to start monetary tightening. On the technical front, as I mentioned, in case of COMEX gold, 1834, $1836 an ounce remains a key resistance, and on the lower side, the support is near 1770. So kind of a inverse HNS is forming in COMEX gold. with right shoulder support near 1770, but it is still in the formation phase. So it needs to move above 1836 for that formation to complete, and if that happens, we might see a sharp rally in gold prices. On the flip side, dollar 1770 remains a crucial support. If that is taken out, it might further move lower towards 1750, 1740 dollar an ounce. We need to wait and see whether the inverse HNS formation completes and gold starts to move higher. Only a break of 1836 would confirm that on a closing basis. In case of silver, as expected last week also we mentioned that it needs to sustain about 24.80 $25 an ounce, because it was a trend line resistance, and if that happens it might move up till 25.50 to $26, but it did not happen and it took the resistance and it has again come down. But it is still holding the support of 22.80 dollars per ounce. So if 22.80 is taken out on a closing basis, we might see further sell off in silver prices. Otherwise, we expect a range bound move between 24.80 on the higher side and 23.30, 23.40 on the lower side to continue. Again, the dollar index and the central bank stance would continue to impact. Also, the base metal prices would continue to impact silver prices. Coming to energies, after crude oil, after a sharp movement in previous weeks, the crude oil for a second consecutive week witnessed a mixed trade but managed to end higher. We may see volatility continuing as market players assess the demand supply impact of recent storm activity in the Atlantic. The biggest factor supporting crude oil price is the delay in restarting production that was shut in the Gulf of Mexico. The effect of storm related closures were also evident in weekly inventory report. While US is struggling with tighter supply, China rattled in energy markets last week by stating that it wants to use strategic reserves to keep a check on prices. Crude oil has continued to rise. However, increased volatility and mixed trade reflects lack of confidence in the market. As per US CFTC report for the week ended September 7th, non-commercial traders for NYMEX crude futures have cut the long positions by 2.1% after cutting it by 4.8% a week ago. On the other hand, Brent crude speculators raised net long positions by 1.7% after raising it by 11.9% a month ago. Uncertainty about US supply amid storm impact may have led to the shift to Brent crude. Crude oil is said to remain volatile, and this may cause traders to turn more cautious. Demand optimism remains challenged by persisting virus risks and concerns about China. OPEC Plus may raise output gradually and act as per demand expectation. However, there is still uncertainty about US supply. US production has been steady. However, storm activity in Atlantic has caused some disruptions. So overall, there is a lot of uncertainty, and prices are likely to remain volatile and trade in a broad range. On the technical front, $71 in case of WTI crude remains a key level. Any close above $71 would indicate a breakout, and crude might once again target $74 a barrel. On the flip side, until $71 holds, we might see a broad range movement. So on the lower side, we expect $68 to $67 to act as the floor. So the ideal range would be 67 half, and $71 on the higher side. But on a close of $71, we might see crude edging higher towards 73, 74 again. In case of natural gas, we have been telling since last couple of weeks that it is overstretched, but it is still going higher because whatever bearish confirmation comes, it doesn't confirm. Initially, we got bearish engulfing formation, but it did not confirm. Last week, there was again bearish confirmation, but bearish formation, but again it did not confirm. So until the confirmation of a reversal is seen in natural gas, the trend remains cautiously higher. However, as I mentioned, one needs to be very cautious in long position because it is overstretched and we might see a corrective phase anytime going ahead. Lastly, in case of base metals have seen volatile moves. Last week, copper moved higher, and yesterday we saw a good bit of a correction because the overall trend in copper is still weak until 771, 72 in case of September contract on MCX holds. Because there is a big head and shoulder formation. So until 771, 772 holds, the broader view is bearish. But we need to look at lead and aluminium. Lead, as we mentioned last week, it came out of the triangle and it had hit around 188, 189 on the higher side. It still looks bullish, and the possible target as per the triangle comes to around 208. So any dip in lead should be used as a buying opportunity. The reversal will happen only below 176. Aluminium had a fantastic rally. The same formation was seen in aluminium also, which is seen in lead. But aluminium has already completed the target near 230, 232, and yesterday's close has formed a dark cloud cover. The confirmation will be only below 225. So any close below 225 would confirm the dark cloud cover, and a corrective phase might start. In that case, 235.50, which is the pattern high, would act as the stop loss. Finally, in case of nickel, there is an evening star formation on charts after yesterday's close. The confirmation will come only below 1480 close. So if that happens, we might see MCX nickel prices enter into a corrective phase with a day before yesterday's, that is Friday's high as the stop loss, that is the pattern high. So overall, base metal looks mixed. Lead is looking positive. Nickel and aluminium are showing reversal signals. Copper is already in a broad corrective phase until the resistances hold. Other than that, as I mentioned, crude looks to trade with high volatility, and gold silver might take direction from dollar, and for that CPI data would be very crucial this week. Other than the CPI data, the next week's Fed meeting will be very, very crucial. So that brings me to the end of this edition. Good luck and trade safe.